Building your business was hard, and you only sell it once. With a focus on marketing, communications, digital, and service businesses, the TobinLeff M&A advisory team is dedicated to helping owners maximize and monetize their life's work. Welcome to the TobinLeff M&A podcast.
Welcome. Hi, I'm David Tobin from TobinLeff M&A Advisory Group. I am pleased to be joined by two of my partners, Mary McKinney and Chuck Gottschalk. We're here to share with you a topic which I'm sure you can appreciate when you go through the M&A process, how to get your deal across the finish line. As you know, there would be nothing as it relates to business more frustrating, more deflating, than if you are ready to sell your company, you go through the process, and your deal does not close. TobinLeff, like any M&A advisory group, you take pride in getting your deals done. We're pleased with our performance. We want to share with you what we have found from our travels, our experience, what can and should be done to get a deal closed. But first, my partners, your background. Mary, you, please, first.
Absolutely. So I'm Mary McKinney Flaherty. As David said, I'm a partner here at TobinLeff. And my background and training is as an attorney. I worked with many closely held business owners throughout my career in various capacities at various stages of their business life cycle. And late in my career as a lawyer, went back to business school on the weekends and was very fascinated by, interested in M&A advisory work. And I was introduced to Chuck and then to David and loved what I learned at TobinLeff about our mission, our commitment to helping business owners maximize and monetize their life's work. It's my privilege to help do that every day and to help really get those deals across the finish line.
And if I may, you're a lawyer who's become a rock star at getting deals done.
She has.
Chuck, your background.
Yeah, Chuck Gottschalk, born and raised in Pittsburgh, CPA by training. I come from a family of accountants. I was a senior manager with Ernst & Young, one of the big four accounting firms. I left there in the late 90s, and I found myself at a family office. And the way that I got there was an M&A transaction that we looked at that didn't get across the finish line. Interesting, we'll be talking about that, but that was the catalyst for me to really begin working in M&A. And I was with that family for about 18 years, and then I started working with you in 2018. What I love about what I do, David, is that I make sure deals get done. And one of the things that I bring to bear that I think separates our firm from some of our competition is that buyers tend to have greater resources than sellers. They tend to have deeper pockets, and they have very experienced M&A advisors. And those experienced M&A advisors will come in and they'll want to put pressure on the price and bring it down. And we don't want that to happen. And I become, in effect, the great equalizer. And I love that. I love standing up for our clients. I love making sure that they sell their companies for what they're worth. We can't sell for more than what it's worth, but we can sell it for what it's worth. And I love that. And delighted to be here and talk about this today.
Great. So what we are going to share, we're breaking it into 7 categories from our experience, impact your ability to get a deal done. Building relationships on all fronts, preparing in advance, preparing like you never have before, telling your story, being proactive, controlling the process, running a profitable business while you're going through the process, and keeping your eye on the prize. So, building relationships. We had a whole podcast just on that subject, but to summarize it as it relates to getting a deal across the finish line, why is it so important?
Trust is essential. I mean, trust is essential at all pieces in all of the relationships in a deal. So that's first working with a seller, with our clients, to build trust with them and us, to ensure that they know that we have their best interests at heart and we're committed to that. It's building relationships to the extent that the leadership team from our clients is involved and aware of the transaction early on, that they also understand what's going on, and we work to build those relationships. Essential to getting the deal across the finish line is really building those relationships with the buyer's advisory team as well. So that's the full PE team, that's the quality of earnings team, that's counsel on all sides. So that's our clients' advisors. I mean, it really is about building trust. These are difficult transactions, and it's important to make sure that we all know that we're there to get something across the finish line because it's meant to happen. When we have our clients commit to an LOI, when they get to that stage, it's because there are two people, two groups who want to come come together, and we work to build trust to get that deal done.
If I may, just to that point, our structure is to allow clients to have the needed time to get to know multiple prospective buyers. Not just reverse due diligence that you may do on the buyer, but values, visions.
Yes. Yeah, I'd like to add that I think that it's so much about building the relationship with the right partner. And so it's just like when we dated when we were younger. You go through a number to find the right one, and then you can build a strong relationship. But you have to start in some ways with the right partner, and that's about interviewing up front. And let it be interviewing your M&A advisors, interviewing prospective buyers, the whole process. I think building a relationship starts with picking the right partners.
Oh, good. So the next topic we said, quote, prepare like never before as you're coming into the M&A process. What does that mean, prepare? Certainly prepare your company, your team, but what does that mean?
It's a marathon, not a sprint. Mm-hmm. And there's a lot of work and preparation that needs to go into it to make sure when you get to mile 24 that you can keep going across that finish line. That's getting your diet in order, it's getting the financials in order. Chuck will talk about that in detail in a minute, but it's also preparing yourself, preparing your team, making sure that you're ready so that you can it's essential to keep running the business as you'd run the business throughout the transactional process. You cannot take your eye off the ball, because that's the sort of thing that'll have a deal fall apart. But it's making sure that your growth plan is together, that you have the story of who you are, that you're able to sell the value proposition of the company. But really, a lot of this does go into the financial preparation and where we add value, and I'll let Chuck take that.
Yeah, when you say build like never before, I think that that's so true, because you have to do things differently than you've done them in the past. Most of our clients focus on cash-basis financial statements, and buyers are going to demand accrual-basis financial statements. So you have to do things a little bit differently, and you have to make sure that your house is in order, because the advisors that are going to come in after what I call the dating process, when the LOI is signed, or letter of intent, when people agree to sort of get married, those people are going to come in and look at it very differently than you've probably ever looked at your business before. And that's one of the reasons why you just have to do it very differently.
Chuck, what about setting expectations? That if an owner's expectations are such that we believe the market will not present at that level, what can we do to help set expectations?
Well, I'm a little confused by the question. We work really hard to set expectations as to what the value is. We have 250 transactions we've been involved with, and we know a range of value. We can't tell you specifically what your company is worth, but we can give you a good sense of that range. And if an owner's expectations exceed that in a material way, we'll go back to the first thing about building relationships. You won't really build one with us, because we'll tell you the truth that we can't sell at that price. We know some of our competition out there will say, yeah, we can sell at these multiples. And I always like to say, a multiple of what? And there's different ways to measure earnings in terms of, over a 3-year average period, a forecast, and all different types of multiples. But we try to come in with what's it worth in dollars as opposed to a multiple.
On the topic of preparing, everybody wants to be in any type of negotiations from a position of strength. Mary, Plan B's, how we help our clients if there is an alternative. Touch on that, please.
Absolutely. So we often, it's important to know what your best alternative to a negotiated agreement is in any instance. And so we will work with our clients to figure out what their plan A is. Oftentimes with our clients, that is an external sale. That might be an external sale to a private equity buyer as a platform company, and plan B might be to sale to a strategic buyer, or it might be the reverse, depending upon our client's desires. Factors that would influence that is our client's desire to stay involved in the business for a period of years versus wanting a shorter term exit. Other factors that might affect that would be the role of the leadership team. Sometimes we'll work with our clients to see whether an internal sale is a possibility. For some of our, for smaller transactions, that often is possible. And you can even sometimes structure that for a larger transaction to transfer ownership to key members of the leadership team. It's important to have that backup so that you don't ever feel under pressure to close a deal that's not intended to happen. I mean, we talked about the importance of building that relationship, of making sure that when we get to that stage that you're going under LOI with someone that you really do want to build a business relationship with. But if that doesn't happen for whatever reason, or perhaps there's a negative quarter in the business or few quarters and there needs to be an alternate plan, it's important to have that backup so that you're not caught flat-footed and then end up in a bad situation.
For sure. So a business owner has crystallized their vision. They know what their plan A is. Their value expectations are realistic. Everybody wants to exceed that, but they have the data. So now they're entering the process. How are we telling their story? Both the qualitative and the quantitative. Chuck, telling stories financially, what's normally important that's presented in a SIM, a confidential information memorandum, or the data room?
Yeah, what you need to do is make your story easy to understand from a financial perspective. I say if I'm doing my job right, you don't spend a lot of time talking about the numbers. You talk about the business. And that, again, just as simply as getting your house in order and making it so that somebody can pick up your financial statements and quickly understand what they say. I've seen P&Ls from some of our clients that have 500 line items on them. It's overwhelming. If you were to hand that to a buyer, it wouldn't go very far. So we consolidate that information and we present it in the way that we know that buyers, and in some ways buyers' representatives, need to see it. And that's really the critical factor up front, is getting it in what we call GAAP compliant.
What about add backs? You hear often that there's a lot, there's subjectivity in it and there's negotiation. Touch on add backs to EBITDA.
So add backs, David, are when an owner will treat the business a little bit differently than if they were an employee of a third party. And so these are expenditures that will not exist going forward and would not be reasonably expected to exist going forward. And they will increase the earnings and increase the valuation of the company. You really need to find the right advisor to come in and cast all of those in a light most favorable to you. Because what you know is the buyer's representatives are going to come in and try to knock those numbers down. It's just the nature of the buyer's representatives wanting to establish their value that, they said the earnings were X and they were only 90% of X. We see that all the time. And so you have to find the right partner to make sure that you're presenting those numbers in that light most favorable. And we focus on that by doing a really deep dive, and we do some data mining on our clients to figure out where we can find those numbers. And we also have the experience of having done so many transactions that we know where to look to find the big dollars.
So we have the quantitative, Mary, telling a story. What's so important in the message, visioning?
Absolutely. So there's really three key elements to telling that story. The first would be the value proposition of the company. Who are you? What do you do? Making that clear and understandable, like the financials, so that we can send out a teaser letter, we can send out communications, and people know what they're looking at. The second piece is the team. Who is doing the work? That's essential. If we're working with services businesses, who are the owners, who's running the business today, and who's the leadership team that's going to be taking into the future, and what are their capabilities, and how committed are they to the business? And essential to really maximizing value in a transaction is a growth story. And so that is, what is your vision and your plan for future growth? So this is how the business is operating today. What are the opportunities, perhaps using the resources of a financial sponsor, perhaps combining with the capabilities of a strategic buyer? What can they do looking at the macro environment and other opportunities to exist? What are they capitalizing on, particularly if they have capabilities in AI or other things that are really important, or how they might leverage that and how they are today? That's really essential to upping the value of a business.
So we're working with our clients to get a deal done. How should we and our clients control the process? What are some ways that we keep this on track and hopefully the direction our clients desire? Whoever.
Yeah, I'll be glad to go. So, controlling the process is being in front of all of the numbers, because once you've actually gone to an LOI phase, or again, letter of intent, when you've agreed to be sold, there's this objective process that happens. The subjective nature of the value of the earnings is eliminated, and now we're just drilling down. And you have to know your business, and you have to be prepared each month to close with detailed accuracy, because they're going to be monitoring those results during that period of time. It takes 60, 90 days to go through this QofE process and to get to a signed agreement. And during that point in time, you have to deliver the numbers you had promised. So you have to be in front of any issues that come up. And you also have to acknowledge when mistakes happen. Just last week, we had a situation where a client changed their accounting method between years, and not to get too granular, but that changed the numbers. And it changed it unfavorably. And we went immediately. It took us about 4 days to sort through the whole issue. And we immediately went to the buyer and talked about it. That's controlling the process. When you're delivering that type of information with your messaging, if you just let them figure that stuff out, they'll make their own interpretations or misinterpretations.
Mm-hmm. And
please,
also keeping in mind why the client wants to do this deal in the first place. What's driving this? So we often talk about the importance of building an advisory team for purposes of the deal. And that's our clients' lawyers, that's financial advisors. And everyone who is working with every one of our clients is always there with their best interests in mind. But they're coming with different training and different lens. And so sometimes there may be, we've been in situations where attorneys on either side of a deal will really dig in on issues that are relatively small with respect to, I mean, Chuck and I were working through one the other day. It was probably a $200,000 issue on a $30 million deal that almost blew things up because there was such a digging in on positions. And so it's making sure that we work with our clients and work with their advisors to ensure that we're focused on what the big picture is here. Quantifying risk can be very helpful because lawyers aren't always, that's not their expertise. And again, they are there, and I will defend my people. They're there looking out for their clients' best interests. But sometimes, based on our training, and everyone is coming at it from a different lens, it's really important that we make sure that we keep the big picture in mind. And that's to the extent that there are two groups, two people, two companies, a private equity group and a company that have decided that there is a future for growth together, that financially, relationally, from a value proposition standpoint, that this is something that can be successful, then everyone should be working to get that done and across the finish line and not get distracted by the small details. And I think that's where having a team that has diverse strengths like Chuck and I with our backgrounds in accounting and finance and law can really help to speak that language and make sure that we move that forward.
And diverse backgrounds and sometimes diverse opinions, because I don't agree with you that all your lawyers' friends are have our clients' best interest at heart. I see it all the time where the deals get over-lawyered and they're treating it like a GE acquisition. And, that's very different. We focus in the services space. We spend a lot of time with companies that their main cost is labor. And it's fundamentally a different transaction than if you're a manufacturer or a consumer products company. And so with that in mind, these lawyers will not actually take that in mind, I should say. And they treat all the deals like they're the same. And that can cause problems.
Unfortunately, we have some strong relationships with lawyers that support. It goes back to building relationships, having a vision. So 2 more topics before we lose our viewers' and listeners' interest because of time. Running a profitable business during the M&A process. How important is it? It's a loaded question.
You have to run it like you're not going to sell it, like the deal's not going to happen. I know that all we're talking about here today, that the deal's going to happen, but assume it won't happen. And that's if you keep that as to your focus, you'll keep running the business the way you always have. And if you don't spend all your time focusing on the transaction, you'll be well served, because it is possible that it won't get across the goal line.
you cannot take your eye off the ball. Deals can take longer to close. Things can happen in the interim, and it's essential to keep generating new business, to keep working those client relationships, to keep moving things forward in the way that you always would, and to keep investing in the business. I mean, make those capital investments, do those things. We can normalize and make adjustments to the extent necessary if they're one-time expenses, but you should not take your eye off the ball of running the business.
For sure. So running a profitable business, treating it like you're not going to sell. Coming into the process, you've got to keep pressure on your new business pipeline. I mean, it's like all hands on deck on the sales front. Because, Chuck, you had mentioned not only during the cultivation process, but the due diligence process, buyers are going to want to see numbers monthly. So it's focus on business development, running your business profitably. One more topic. We touched on it, but keeping your eye on the prize. Mary, you mentioned a moment ago that, a couple $100,000 issue almost lost a multi-million-dollar deal. What should our clients and the advisory team be doing to that point, keeping their eye on getting the deal done?
I think two things. One, understand there will be bumps in the road. It's inevitable that things will come up during the due diligence process, either through the numbers or just in the evolution of the business. We had a situation several years ago with a transaction where all of a sudden the numbers didn't look right in a particular month and unfavorably. And we had to do a deep dive into that and figure out what was going on. And actually, as it turns out, they entered into a new business line, and it was a favorable thing. So you really always have to just be prepared that there will be changes in the business, and it will put stress on the transaction. It's understanding that that's normal. We sometimes will call it the emotional roller coaster. And if you know that you're going to go on this roller coaster ride, you won't be scared when you're coming down those scary hills.
Great. Mary, Chuck, thank you. Thank you for joining us. TobinLeff, we're here to help our clients appreciate it, understand their exit options. If they make the decision to go to try to sell it, we would work as a team to get your deal across the line. If you ever want to speak with any partner, we have 8 partners at TobinLeff, call us. We'd love to talk about your plans, your ideas, share what's going on in the marketplace. So please find us at TobinLeff.com. Thank you.
Thanks for listening to the TobinLeff M&A podcast, produced by Main Impact with music by Holt Vaughn. For additional resources, case studies, or to contact a partner today, visit TobinLeff.com and be sure to subscribe or sign up for our emails to never miss an episode.